Let's begin with a truth most traders deny. Revenge trading does not begin with anger. It begins with imbalance. An imbalance is far more dangerous than anger, because anger you can see. Imbalance is invisible. It hides behind calm words and steady breathing. It disguises itself as confidence, as decisiveness, as opportunity. But underneath, your nervous system is running a completely different program, one that has nothing to do with the next trade and everything to do with the last one. Let's slow this down, because what happens in the minutes after a loss, what happens inside you, is the most underexamined period in trading psychology, and it is where careers are quietly destroyed. Revenge trading does not begin with anger. It begins with imbalance. A loss occurs, the trade closes, your position disappears, capital decreases, and internally something feels unfinished. You tell yourself, it's fine, losses happen, but your nervous system is not neutral, it is activated, and activation changes decision quality. Let's be precise about what activation means. Activation is not panic. It is not rage. It is a subtle physiological shift. Your heart rate elevates slightly. Cortisol enters the bloodstream. Your attention narrows. Your thinking accelerates. You do not feel out of control. You feel ready. And that feeling of readiness is the danger, because it is not readiness. It is urgency wearing the mask of readiness. Loss creates psychological tension, not because of the money alone, but because of expectation. You expected that trade to work, even if you understood probability intellectually, even if you told yourself before entry that this might fail. Emotionally, you believed this one would succeed. When it doesn't, the mind seeks correction, not reflection, correction. And correction often comes through action, fast action, impulsive action. That is where revenge trading begins, not in the heat of the moment, in the quiet that follows, loss, in the moment when the mind whispers, get it back. Let's go inside the brain, because understanding what happens neurologically after a loss changes how you respond to it. The brain processes financial loss through the same neural circuits that process physical pain. This is not a metaphor. It is neuroscience. A 2009 study in the journal Neuroimage demonstrated that monetary loss activates the anterior insula, the same region of the brain associated with the experience of physical pain. When you lose a trade, your brain is not just processing a number, it is processing hurt. And when the brain experiences hurt, it activates its oldest survival response, threat detection. The amygdala fires, the hypothalamus signals the adrenal glands, cortisol and adrenaline flood the system. Your prefrontal cortex, the part responsible for patience, planning, and rational risk assessment, becomes suppressed. This is the same mechanism we explored in the previous video, the same mechanism that prevents you from honoring stops. Now it is working in a different direction. Instead of keeping you in a losing trade too long, it is pushing you into the next trade too fast. Same neuroscience, different expression. There's also a concept in behavioral economics called loss aversion. Research in this field consistently shows that the psychological pain of losing a given amount of money is roughly twice as powerful as the pleasure of gaining the same amount. Think about that. Losing $100 feels twice as bad as winning $100 feels good. This asymmetry is built into us. It is evolutionary. It kept our ancestors from taking risks that could end their survival. But in trading, it becomes a liability, because it means every loss carries disproportionate psychological weight, and disproportionate weight creates disproportionate urgency to recover. That urgency is revenge trading at its biological root. You are not being undisciplined, you are being human. But understanding the mechanism gives you the ability to interrupt it, and interruption is where professionalism lives. Part 3. The subtle shift in standards. Here is what makes revenge trading so difficult to detect in yourself. It rarely looks reckless. Under neutral conditions, you have criteria. You wait for structure. You wait for confluence. You filter the noise. You let the setup come to you. After a loss, those filters weaken. Not collapse, weaken. And that distinction matters, because if your standards collapsed entirely, you would recognize the danger immediately. You would see yourself making obviously poor decisions. But when standards weaken subtly, everything still looks reasonable. You begin seeing setups that previously would not have qualified, a structure that is almost clean, a momentum signal that is kind of aligned, a level that is close enough. You rationalize. This is similar to what I look for. The conditions are basically right. It's not perfect, but neither is anything. And technically, none of these thoughts are wrong. No setup is perfect. Conditions are rarely ideal. Patience has diminishing returns. But here is the critical distinction. Before the loss, you were filtering with objectivity. After the loss, you are filtering with urgency. The setups haven't changed. Your perception of them has. And that perceptual shift, invisible, subtle, driven by the need to recover, is the beginning of the erosion. Revenge trading is rarely reckless at first. It is slightly compromised discipline, and slight compromises compound. One marginal trade leads to a marginal result. The marginal result increases urgency. Increased urgency lowers standards further. Lower standards produce another marginal trade, and you are in the spiral before you ever recognized it began. Watch what happens to timing after a loss. Entries become faster, not dramatically, but measurably. You hesitate less before clicking. The pause between seeing a setup and acting on it shortens, not because your confidence improved, because your impatience increased. The mind wants resolution. The market operates on its own timeline. Your mind does not care about that timeline. It wants the loss gone. It wants the account restored. It wants equilibrium now. That mismatch between your urgency and the market's indifference creates premature entries. You enter before confirmation arrives. You enter before the structure resolves. You enter because waiting feels unbearable. And premature entries create poor positioning. Poor positioning means your stop is too close or your entry is at a disadvantaged level. Poor positioning increases the likelihood of being stopped out. Being stopped out increases the loss. Increased loss increases emotional activation. Increased activation increases impatience. Increased impatience speeds up the next entry, and the spiral accelerates. This is not a character flaw. This is a predictable behavioral response to loss under stress. But predictable does not mean inevitable. Predictable means it can be anticipated. And what can be anticipated can be interrupted. There is a concept worth understanding deeply. Emotional impairment. Not the dramatic kind, the invisible kind. When most traders think about emotional impairment, they imagine someone slamming a keyboard, shouting at a screen, making obviously irrational decisions. But that is not how emotional impairment usually manifests in experienced traders. Experienced traders have enough self-control to maintain composure on the surface. They sit still. They breathe normally. They speak calmly. But underneath that composed exterior, their decision-making architecture is compromised. Because stress hormones do not care about your composure. They operate below the level of conscious awareness. Loss elevates cortisol. Elevated cortisol narrows perception. Narrowed perception reduces the range of information you can process simultaneously. You become outcome-focused. Instead of asking, "Is this setup statistically valid?" you ask, "Can this trade recover what I lost?" That is a dangerous shift because it reframes trading from probability to restitution. Probability asks, what is the expected value of this trade over many repetitions? Restitution asks, what do I need from this specific trade right now? Restitution is personal. Probability is mathematical. Markets respond to mathematics. They do not respond to personal need. And yet, in the emotional aftermath of loss, nearly every trader defaults to restitution thinking. The antidote is awareness. Specifically, the awareness that your emotional state after a loss is not neutral, regardless of how calm you feel. That awareness alone creates space, and space is where better decisions are made. Part 6. The detailed scenario. Let's walk through this in real time. You take a trade. The setup was valid. The risk was defined. The stop was placed. Price moves in your direction briefly, then reverses. It hits your stop. You're down 1%. You close the trade. You take a breath. You tell yourself you're fine. But 20 seconds later, you're scanning charts. Not with patience, with purpose. You are looking for something. Not the best trade available, the fastest trade available. You find a setup. It's not your A-grade setup, but it's moving. It has momentum. You tell yourself the momentum is enough. You enter. Immediately, price stalls. It moves sideways. Then it starts dropping. You feel it before the numbers confirm it. That familiar tightening. But this time, there is something else underneath it. Frustration. Not just at this trade, at the last one, at the account balance, at yourself. The trade hits its stop. Now you're down 2% on the session. You intended to risk 1% total today. You have already doubled that. And here is the critical moment. The moment that separates traders who recover from traders who spiral. Do you pause, or do you scan again? Most traders scan again, because the mind is now fully activated. The loss has compounded. The urgency has doubled. The rational brain is further suppressed. And the next trade is even faster, even less qualified, even more desperate. This is how 3% losing days become 5% losing days. Not from one catastrophic decision, from a cascade of slightly compromised ones, each one feeling in the moment like it makes sense. Part 7. Identity and self-image. Loss challenges self-image. This is deeper than most traders acknowledge. You believe you are disciplined, capable, methodical, serious about your craft, and then a loss arrives. And loss, especially a loss that feels undeserved, introduces doubt. Not just about the trade, about you. Did I read that wrong? Is my edge real? Am I actually as good as I think I am? These questions are uncomfortable, and the fastest way to silence uncomfortable questions is to act, to prove through immediate action that the doubt is wrong. If I can win now, I'm still sharp. If I can recover quickly, the loss was just noise. If I can get back to even, none of this counts. Revenge trading is often an attempt to restore identity, not to restore the account, to restore the self-image. And that motivation, trading to feel better about yourself rather than to execute a valid edge, is one of the most destructive forces in this profession. Because markets do not care about your self-image. They do not reward you for needing to feel competent. They reward correct positioning. Full stop. When your motivation for a trade shifts from edge to ego restoration, you have already lost before the trade begins. Professionals understand this. They do not rush to restore identity through recovery. They preserve identity through consistency. The consistency itself becomes the identity, not the result of any single trade, the process across hundreds of them. Part 8. Anonymous Lessons from Professional Traders. Some of the most enduring wisdom in trading comes not from textbooks, but from the habits of professionals who survived long enough to develop deep perspective. One principle shared across many successful traders is this: your best trades come when you are least attached to the outcome. Read that again. Your best trades come when you are least attached to the outcome. After a loss, attachment to the outcome is at its highest. You need the next trade to work. You need it to recover. You need it to prove something. That attachment clouds judgment. It distorts risk assessment. It inflates confidence in marginal setups, and it leads directly to the revenge trade. Another principle, widely observed among professionals who have managed money through multiple market cycles, is this: the size of your drawdown is proportional to your emotional state when you entered the trades that created it. Not your technical analysis, not the market environment, your emotional state. Professional risk managers and institutional trading know this. When a trader on their desk begins revenge trading, experienced supervisors do not review their charts, they review their psychology. They ask, what happened before the spiral started? What was the emotional trigger? When did this trader stop trading their system and start trading their feelings? The answers are always the same: a loss, then urgency, then compromised standards, then escalation. This pattern is not unique to retail traders. It exists at every level of the profession. The difference is that experienced professionals have systems to interrupt it. They have rules. After a losing trade, reduce size. After 2 consecutive losses, stop for the session. After a session loss that exceeds a defined threshold, do not trade the following morning until emotional state is assessed. These are not signs of weakness, they are signs of self-awareness, and self-awareness in trading is a competitive advantage. The escalation pattern. If the revenge trade loses, something shifts. Now urgency intensifies. The mind interprets consecutive losses as threat, not just financial threat, existential threat. And existential threat triggers escalation. You may increase position size, not because the setup warrants it, because larger size means faster recovery. You may widen stops, not because the structure demands it, because you cannot absorb another stop-out psychologically. You may trade more frequently, not because more setups qualify, because inactivity feels like surrender. Each of these decisions is driven by one invisible force, ego demanding restoration. And the market, indifferent as always, simply continues moving. It does not notice your urgency. It does not reward your desperation. It does not punish you intentionally. It simply moves. And the gap between what you need from it and what it delivers grows wider. Let's look at this mathematically. You begin the session with a 1% loss. Your intention was to risk 1% maximum for the day, but you revenge trade. Second trade, another 1% loss. Now you are down 2%. The urgency doubles. You increase size. Third trade, 1.5% loss on the large of size. Now you are down 3.5%. This is more than 3 times your intended daily risk, and it all started with 1%. 1% became 3.5, not from bad analysis, from bad psychology. The mathematics of revenge trading are unforgiving because each loss does not just reduce your capital, it increases your emotional activation. And increased activation produces worse decisions, which produce larger losses, which produce more activation. This is the spiral, and the only way to exit it is to stop. Physically stop. Not think about stopping. Stop. The cost over time. Revenge trading rarely destroys accounts in a single session. It erodes them gradually. This is important to understand because gradual erosion is harder to detect than sudden collapse. A trader who blows their account in one day recognizes immediately that something went wrong. A trader who erodes their account over 3 months through repeated revenge cycles may not see the pattern at all. They see individual losing sessions, individual bad trades, individual decisions that felt reasonable in the moment, but they do not see the thread connecting them all. The thread is always emotional. Slightly lower standards after a loss here, slightly faster entry after a loss there, slightly larger size to recover from a drawdown here, slightly wider stop to avoid another stop out there. None of these decisions feels catastrophic. Each one feels like a small adjustment, but small adjustments compound, and what compounds negatively over months looks exactly like this. Inconsistency. Some weeks profitable, most weeks flat or down. A few trades spectacular, too many trades embarrassing. No clear edge visible in the data. The trader blames the strategy. They buy a new system. They change their approach. They start over, and the cycle repeats. Because the problem was never the strategy. The problem was the psychological response to loss. And that problem travels with you to every new system, every new market, every new account, until it is addressed at the root. There is good news in the neuroscience. The same brain that gets hijacked by loss can be reset, and the reset does not require hours, it requires minutes. When cortisol floods the system, the prefrontal cortex goes quiet. But cortisol has a half-life. It does not stay elevated indefinitely. Under normal conditions, cortisol begins to reduce within 15 to 20 minutes of the stressor being removed. This means that if you step away from the screen for 15 minutes after a loss, not to think about the loss, not to review the trade, just to step away, your brain chemistry begins to normalize. Your prefrontal cortex reactivates. Your perception widens. Your patience returns. Physiological techniques accelerate this reset. Slow, controlled breathing, specifically extended exhales, activates the parasympathetic nervous system. The parasympathetic system is the counterforce to the stress response. It signals the body that the threat has passed. It lowers heart rate. It reduces cortisol. It restores rational thinking. 4 counts in. Hold for 4. 6 counts out. Repeat 4 times. That is 90 seconds. 90 seconds of deliberate breathing can measurably shift your physiological state. Light physical movement has a similar effect. Standing up, walking to another room, 5 minutes outside. These are not soft suggestions. They are neurologically grounded interventions. Professionals in high-stakes environments, surgeons, pilots, special forces operators use exactly these techniques to maintain decision quality under stress. Traders operate under comparable psychological pressure. The same tools apply. Treat your nervous system like equipment. Maintain it. Reset it when it needs resetting. Because no strategy improvement, no indicator, no new system will perform at its potential if the brain operating it is running in stress mode. To prevent revenge trading, you must insert friction between the loss and the next trade. Friction is intentional delay, and intentional delay is one of the most powerful tools in trading psychology. Here is the principle. Revenge trading requires speed. It requires moving from loss to next trade without pause, without reflection, without assessment. The entire emotional mechanism depends on momentum. Urgency builds. Action follows urgency. If you break that momentum, even briefly, the urgency loses its grip. The practical application is simple. After any meaningful loss, implement a mandatory pause, not optional, mandatory. Define it before the session begins. Write it in your trading plan. After any loss that exceeds X%, I will step away from the screen for 15 minutes before placing another trade. That rule, written in advance in a calm state, becomes your protection in the heat of the moment. Because in the heat of the moment, you will not want to pause. Your mind will generate compelling reasons to trade immediately. The setup is right there. If I wait, I'll miss it. I need to stay focused. These thoughts are the urgency talking, not your edge. Your pre-written rule is your edge talking. Honor the rule. The setup will still be there in 15 minutes, and if it isn't, a better one will emerge. There is always another trade. There is not always another account. Additional friction tools. Close the platform entirely after a loss. Physically move to a different room. Write in your trading journal before re-entering the market. Require yourself to verbally state out loud why the next trade qualifies before entering it. These tools feel excessive when you read them in a calm state. They feel essential when you are activated. Build the friction now. Use it then. The core shift in thinking. Stop asking, how do I recover this loss? Start asking, is my next trade statistically valid? The difference between those two questions determines your long-term trajectory. They look similar on the surface, but they come from entirely different places. The first question is backward-looking. It is anchored to the loss. It is asking the next trade to carry the weight of the previous one. That is an unfair burden, and it distorts every decision that follows. The second question is forward-looking. It is asking only what the current data supports. It is treating the next trade as independent from the last, which it is. Statistically, each trade is independent. The market has no memory of your previous position. It does not know you lost. It does not know you need to recover. The only way to approach it honestly is as a fresh probability event, untainted by what came before. This shift from recovery thinking to probability thinking is the intellectual foundation of consistent trading. Recovery mindset is short-term. It optimizes for the next trade. It trades outcome for urgency. Probability mindset is long-term. It optimizes for the series. It protects edge over individual results. It trades urgency for process. One of these mindsets builds equity curves. The other erodes them. You already know which is which. The work is making the shift under pressure, when the loss is fresh, when the urgency is real, when every instinct says move fast. That is when the shift matters most, and that is when it is hardest. That gap between knowing and doing is where trading psychology lives. Closing it is the work of a professional. Let's talk about identity, not as an abstract concept, as a practical tool. Most traders think of discipline as something they apply to their behavior, a rule they follow, a habit they maintain. But the most durable form of discipline is not behavioral, it is identity-based. When something is part of your identity, it does not require willpower to maintain, it simply is. A person who identifies as a runner does not debate whether to run, they run because that is who they are. A trader who identifies as someone who never revenge trades does not debate the next trade after a loss. They pause, they assess, they trade only when the edge is present, because that is who they are. Identity-based discipline is more resilient than rule-based discipline. Rules can be broken. Identity is harder to violate, because violating identity creates dissonance, and dissonance is uncomfortable enough to prevent the behavior. So how do you build this identity? Through repetition of the desired behavior. Every time you pause after a loss, you reinforce the identity. Every time you honor your friction rule, you reinforce the identity. Every time you close the platform and walk away, you reinforce the identity. Each repetition is a vote for the kind of trader you are becoming. One vote does not determine the election, but over time the votes accumulate and the identity solidifies until pausing after a loss is not an act of discipline, it is simply what you do, because it is who you are. Review your last losing session, not to punish yourself, to understand yourself. Ask these questions honestly. After the loss, did you reduce size or increase urgency? After the loss, did you pause or accelerate? After the loss, did you trade for your A-grade setup or did you lower your standards? After the loss, did you trade your system or did you trade your feelings? Your answers reveal whether you operate structurally or emotionally. Neither answer is a judgment. Both are information. Information you can act on, because awareness precedes change. Without awareness, patterns continue invisibly. With awareness, patterns become visible, and visible patterns can be interrupted. The traders who endure in this profession are not the ones who never feel the urge to revenge trade. They feel it every time. They feel the activation, they feel the urgency, they feel the pull toward the next trade. The difference is that they recognize what it is, they name it, they interrupt it, and they return to process. That recognition, that moment of self-awareness in the heat of emotional activation is the skill, not the ability to feel nothing, the ability to feel everything and act from structure anyway. That is the standard. That is what you are building toward. Not perfection, consistency. Not the absence of emotion, the presence of process. Your growth as a trader begins with self-awareness. Not a better system, not a new strategy, not more screen time. Self-awareness. The ability to watch yourself honestly, to see the activation after loss, to recognize the urgency for what it is, to interrupt the spiral before it begins. Loss is not the enemy. Loss is operational. It is the cost of participating in markets. The enemy is what happens after loss, when urgency replaces patience, when ego replaces process, when restitution replaces probability. That is where accounts are truly lost, not in the losing trade, in everything that follows it. You now know what follows loss if left unchecked. You know the neuroscience. You know the emotional stages. You know the escalation pattern. And you know the intervention. The only question remaining is what you will do with that knowledge. Knowledge without application is just information. Application under pressure is wisdom. Earn the wisdom. I'll see you in the next video. Until then, control your mind.